welcome to this week's MFB News. Hope you're okay. It's been a very busy week here for me. I've been all over the place. Friday, Saturday I was at the Property Investor Show in Excel. Monday I had the absolute pleasure of speaking to some of the landlords at iHouse, and yesterday I did a webinar with Landlord Zone and Paul Champlain on refurbishment finance. So it's a bit of a treat today, to be honest, just to be sat at my desk. I'm very much looking forward to the weekend, as I'm sure we all are. Now, in terms of what we're going to be talking about today, it's kind of going to go interest rates, rents, interest rates, and a bit of inflation. And the reason we're going to be quite interest rate heavy today is there's a bit of news going on. So lots of good stuff for you, which you need to be across, particularly if you're in the market for a mortgage at the moment today. Okay, so interest rates part one, and we're going to talk about swap rates. And I'm afraid, guys, it is a bit of bad news. So what we've seen in the last week is swap rates actually creep up. So we know that they've been going down. But in the last few days, things have actually gone up. So at the moment, to kind of give you an idea about what I'm talking about here, 5-year swap rates, 3.81. Go back 1 month ago, 3.56. So actually a notable increase of almost 0.3%. The good news is that year on year, we're still ahead of the game. So 4.59 1 year ago. So rates are sort of circa 0.8% lower than they were 1 year ago. But there's no escaping the fact that things have floated up in the last couple of days. Now, why is this? I can only assume it's going to be down to things like concern over the very worrying situation in Israel at the moment and the prospect of the Middle East going to war with each other. The other thing that we have in the background is the autumn statement. We know that Labour have been very, very strong on kind of talking down the economy and how their UK is going to do. We also know their rhetoric has largely changed because they're kind of aware of the implications of doing this. But the reality is that has had a knock-on impact. There's lots of concerns around potential tax changes and those kinds of things. So I think the market's probably just feeling a little bit cautious at the moment. Now, that's really where we are with swaps. So let's just keep our eye on that. Now, the fallout of this has meant that actually some lenders have had to reprice upwards, whereas others have been repricing downwards. And I think when we're talking about the lender rates, and this is mortgage interest rates part 2 of today's episode, we need to kind of think about the timings. So last week we saw a sort of, broadly speaking, 8 lenders reprice downwards, then swap rates increased. Now we've seen a little raft of lenders start to put some of their rates up. So it's a bit of a mixed bag this week. But when I'm sort of saying, oh, these rates have come down and these rates have gone up, that's the kind of context around it. So it's not that the lenders who are putting their rates down or up have got different funding models to each other. I mean, they'll have different funding models, but you know what I mean? Their cost of funds hasn't broadly changed. It's purely that there's a real timing element involved here. So in the good news element of this, we have seen rates come down from Virgin, NatWest and Vida Home Loans. Last week, we also saw rates come down from the Leeds on their limited company range, the Nottingham on their building limited company range, Paragon, they dropped their 2-year fixed rates and introduced some really nice 5-year limited edition products. The mortgage works down by 0.3%. So that was kind of pre-swap rates going up. What we've since seen with swap rates increasing is Landbay, MT Finance and Keystone increase at least some of their rates in reaction to this. And I suspect we're going to see a few more lenders react accordingly as well. So I think the kind of message here for you guys is, do keep your eye on swap rates and see what's going on over the next few days. You don't have to wait for a whole week to go by before you find out. But I think realistically, because the cost of funds has now increased, I would be very surprised, and I'm prepared to be wrong on this, but I'd be very surprised if we see much in the way of rate reductions over the next week or so until things settle down. When swap rates climb, and they climb quite quickly actually, so they kind of went up on 5-year swaps, almost 0.2%, increasing to 0.3% week on week. So what happens is those lenders who are borrowing from the capital markets, particularly exclusively, these guys have no choice but to react really quickly. So I think we're probably going to see more rates increasing over the next few days. So if you are thinking about making a mortgage application at the moment and you're kind of, maybe it was a timing thing, you didn't quite have your paperwork together, you're just kind of waiting to see what happens, my advice is for the time being, I'll just crack on and get your application in and try to secure that rate just in case it disappears. Now there is a chance this will settle, and I really do hope that is the case. But for the time being, we're all just feeling slightly nervous and watching the situation very closely. Okay, now we're just going to break up the interest rate chat for a moment by talking about rental yields, because Fleet have released their latest buy-to-let barometer, which is really interesting reading. And there's some quite fun, interesting headline bits of data in here for us. So the average yield for England and Wales, this is according to their data, so this is what they're looking at from all of their mortgage applications, shows an annual increase again, which we were obviously expecting because we know that rents are just increasing across the whole of the UK. The North East continues to lead the average rental yield table at 9.7%. So if yield is really your thing, you're not really fancying HMOs, that kind of stuff, it could be that the North East might be an interesting area for you to consider. 10% of applications came from first-time landlords who are not being held back in terms of their first-time activity. So essentially what I think they're saying here is that actually 10% of all applications coming into Fleet are from first-time landlords. Now this is quite an interesting one because what I noticed when we were at the Property Investor Show on Friday and Saturday is there was actually, I would say, an unusually high number of first-time investors coming over to have a chat with us. So I wonder whether actually there is a whole kind of new swathe of landlords coming into play in the market. I suppose the difference is, for those landlords who have been knocking around for a long time, not only are a bunch of you hitting retirement age, but also you've kind of gone through the kind of real trials and tribulations and also the joy of being a landlord. And maybe you're kind of got to the point where you're just tired of it. Whereas actually there's a whole nother round of first-time landlords coming into the market who are kind of saying, actually, I understand that this is where the legislation and taxation, all that kind of stuff sits at the moment, but I still believe that actually private rental sector is a really good investment. So that's really encouraging, and we can be very happy to have a chat with any first-time landlords who've got any questions. We love supporting the new people to the game. Now, a typical landlord now holds 12 properties within their rental portfolio. Now, this would have been really useful if they'd have told us if that was higher than lower than normal, but I think kind of as a point of interest, the average landlord now has 12 properties in their portfolio if we're looking at the data that Fleet hold. And I'll come on to data and how we can kind of interpret it in a second. But first, lastly, just to say that 77% of all their applications from the quarter were from limited company borrowers. Now, I just want to chat a bit about data for a moment because it's very, very easy to kind of read a report like this one, which is very, very useful. And we genuinely appreciate people like Fleet spending time and resources putting something like this together. But I think what we need to do is, rather than say that actually all mortgage applications for buy-to-let in the UK are through limited companies, a typical landlord, as an average across the UK, holds 12 buy-to-let properties. I don't think that's strictly true because Fleet as a lender, are a very specialist lender. They're really, really good at what they do, but they are attracting the more specialist type of landlords, so limited company applications, no maximum number of properties in the background, that kind of thing. So while their data is really interesting, I think we just need to kind of keep in mind the context of which Fleet operate and the kinds of borrowers they're going to be attracting. Now, just interestingly, just to touch on the yield table a bit more. So in terms of top to bottom, in terms of yields, so as we mentioned earlier, North East average yield here is 9.7%. And then we go down the list. So North West comes next, Yorkshire and the Humber, West Midlands, East Midlands, Wales, average yield here is 7.2%. South West 6.1%, South East 6.1% also, East Anglia 5.9%, Greater London is 5.9%. So if you're thinking about kind of trying a new area to invest in where you haven't kind of invested before, hopefully that information is useful to you. Okay, now back to interest rates again. I want to keep you on your toes today. I just want to kind of turn my head to the comments that were made by Andrew Bailey last week, where he referenced the Bank of England potentially being more activist if inflation were to continue to come down rather quickly. And what this kind of means, or the inference from this, is that the MPC could have the option to bring down base rate more quickly and more aggressively than we have been experiencing so far and what was kind of on the table. Now, looking at market reactions to this, actually, the markets have largely expected inflation to come down next month, so slowing to 1.9% in October. So the market's already kind of expecting inflation to come below the Bank of England's target, but they're still not pricing in further base rate reductions. So it's very, very interesting at the moment. So in kind of where the market sits, in terms of the kind of houses that produce lots of great economic data, the expectation that these guys are coming up with is still very much saying 0.25% throughout the rest of 2024, and then 0.75% worth of reductions throughout 2025, which would leave us at a base rate by the end of next year at 4%. Now, there are going to be differences of opinions here, but largely speaking, whereas, we saw the Andrew Bailey news and we'd been thinking, hooray, base rate's going to come down really fast, the markets are actually not really reacting to that and they're keeping their predictions as they were prior to his statement. Okay, now lastly, just to touch on an interesting piece of lending criteria change, which has come from the Mortgage Works. Now, the Mortgage Works are kind of one of the largest, I think, UK buy-to-let mortgage lender, and they are very, very good. So what they try and do with their offering is they try and have something for everybody. So they've got a range of mortgages for people with less than 10 buy-to-let properties in personal names that are not HMOs. Then they've got a range of mortgages for people with HMOs. They've got a large portfolio offering, and they've also got a limited company offering as well. So lots of different things going on here. So really commendable. And for those of you who aren't aware, the Mortgage Works is actually part of the Nationwide group. Now, I think it's fair to say that while they are very all-encompassing in what they try and do, they're also quite picky in terms of what they do as well. And I think they'd be the first to acknowledge this. So what we find with the Mortgage Works is that they are consistently reviewing their lending criteria. They don't have like the most aggressive risk appetite by any stretch of the imagination, but in fairness to them, what they are constantly doing is trying to see where they can make tweaks within credit appetite to improve things. And the latest thing that they have done is they have now decided to accept intercompany loans when looking at limited company lending, which made me sort of suddenly think actually intercompany loans are quite an interesting one. Not everybody knows what they are, so it's probably just worth us spending a couple of moments talking about these. So an intercompany loan is essentially where a limited company is acquiring a buy-to-let property and the deposit is coming from another limited company. So company A lends company B money as deposits. Now, a lot of lenders do accept this, but not all of them. So it's interesting, and actually lenders have been coming away from this. So it's interesting to see the Mortgage Works come into this market. I guess they're just trying to sort of help service transactions where they can. So what example would this be? So this could be where you have a trading business. So you are, I don't know, a dentist. And in your limited company of dentistry, you've been building up a pile of cash as retained profits. And you've now decided that you'd like to use that money and to it as a deposit for a buy-to-let property. You don't want to buy the property in your dentistry business because you want to keep the two things very, very separate. So you set up a totally new limited company, which is owned by you as a person. It's not owned by the dentistry. So we're not talking about layered companies here. We're just talking about two very separate limited companies which sit side by side, both owned by the same individuals. So when what would happen is to move the money from the dentistry business to the trade, so the SPV, the company would essentially, company A would make company B a loan, which is called an intercompany loan. Now, the reason that this is more tax efficient than essentially drawing the money out into your personal name and then via probably a dividend payment or a payment of a director's loan, and then lending it to your new SPV as a director's loan, is essentially when the money comes out of the dentistry business, it's potentially a taxable event. So what we would want to do, or what is better for you, is if you can lend the money from company A to B, that then could be very beneficial from a taxation perspective. Again, whenever we're talking about taxation, while I have a high level understanding of it, you really do need to get advice from your accountant, your tax advisor. This is not our gig. But that's essentially what's gone on. So it's really fantastic to see the Mortgage Works improve their criteria. Intercompany loans are actually used quite often. So this isn't like a kind of real unusual thing for them to do that hardly anyone's going to benefit from. There's lots and lots of people who have limited companies as a day job who want to then use that money to invest in an SPV and buy a buy-to-let through it. So really great to see those guys. And I hope that at least explains what an intercompany loan is, if you've heard that terminology before. And also if you're wondering how you get money from one company to another, that's one way of doing it. And that's us wrapping up for yet another week. It's going to turn super chilly, I believe, tomorrow, so get your woolies out. If you have any questions, oh, come on, guys, you know we'd love to talk to you, 0345 345 6788. And as always, our website is open 24 hours a day, 7 days a week, with an absolutely huge amount of wonderful information available. Have a fantastic week, look after yourselves, and I'll see you again next time.